On a Tuesday in 2009, two guys with a slide deck and no revenue walked into a Sand Hill Road office. 18 months later, that meeting was worth more than the GDP of a small country. Most people think venture capital is about money. It isn't. It's about access to the next round. Every level of this hierarchy is a different position in line for that access. 7 levels. Let's get into it. Level 1, the angel check, $25,000 to $100,000. This is the friend who made money once and now wants to make it again through you. An angel is an individual writing a personal check into a company that has nothing. No product, no users, sometimes no second co-founder. They are not buying a business. They are buying a story and the person telling it. At this level, the math is brutal and everyone knows it. Most of these checks go to zero. The angel isn't betting on this company surviving. They're betting that 1 out of every 20 will return the entire portfolio and then some. The angel who tells you they saw something in you is telling the truth. Seeing something is the entire job, because there is nothing else to see yet. Level 2, the pre-seed and the syndicate, $100,000 to $1 million. This is where it stops being one person's hunch and starts becoming a small machine. A lead angel or a microfund pulls together a group, a syndicate, and writes a coordinated check. There are now terms. There is now a safe or a convertible note, a cap, a discount, language that did not exist when it was just a handshake. The founder at this level just learned that money is never only money. It is control, dilution, and a clock that starts the moment the wire clears. They are not optimizing for the biggest number. They are optimizing for the investor who will still pick up the phone when the company is 6 weeks from running out of cash. Level 3, the seed fund, $1 million to $5 million. This is where venture capital professionalizes. It stops being individuals and becomes an institution with a name, a thesis, and limited partners it answers to. At this level, the fund has a website, a portfolio page, partners who used to be operators, and an associate whose entire job is to find you before the other funds do. Seed funds raised on the order of tens of billions of dollars in dry powder in recent years. Capital sitting in committed funds waiting to be deployed. The seed fund is also where a new problem appears for the founder. The cap table is now visible. The round is announced. The company has a public valuation. And a valuation is a number you now have to beat. The moment you are funded, you are also measured. If this is landing, hit like and subscribe. Every week I break down how power, risk, and money actually move, not how the pitch deck describes them. Stay with me, because from level 4 onward, venture capital stops being about funding companies and starts being about manufacturing the appearance of inevitability. Level 4, the Series A institutional lead, $5 million to $20 million. This is the round everyone is actually talking about when they say raised venture. A traditional firm on Sand Hill Road or its equivalent takes a board seat, a meaningful ownership stake, and a degree of influence over the company's direction that the founders are only beginning to understand. What does a Series A buy? It buys validation that compounds. The name of the lead firm on your funding announcement is worth more than the dollars, because it is a signal to every other firm, every recruiter, every reporter, that someone sophisticated has already done the diligence. It buys a board member who has done this 40 times. It buys the right to hire a head of revenue. And it buys an expectation, never written down, that you will either grow at a rate that justifies the next round, or you will be quietly managed toward an exit. Level 5, the growth round, and the mega fund. $20 million to $200 million. The most powerful force in late-stage venture is not conviction. It is capital that has to be deployed. The mega funds, the multi-billion-dollar vehicles, do not have the luxury of writing small checks. A fund managing $10 billion cannot move the needle on its returns with a $2 million bet. It needs to write checks large enough to matter, which means it needs companies large enough to absorb them. The growth round does not have a fixed thesis the way a seed fund does. It has a position to fill and a return it has promised its limited partners. The founder at this level has not decided to raise growth capital because the business needs it. They have decided to raise it because the alternative, a competitor raising it first and outspending them into the ground, carries a risk they are no longer willing to accept. Level 6, the platform and the information apparatus. The largest funds at the highest levels are not primarily investors. They are primarily intelligence operations. The most sophisticated firms understand that picking the winner after it is obvious is already too late. What they build is an information function, a network of operators, ex-founders, talent partners, and portfolio executives whose entire purpose is to identify the company that will matter before it has a logo. At this level, the firm knows more about the market your startup is entering than you do. That is the design. They have funded your 3 closest competitors' advisors. They have seen the metrics of every company that tried what you're trying. The founder's job is to build. The firm's job is to make sure that whatever gets built, they already own a piece of the version most likely to win. Level 7, the capital sovereign. Hundreds of millions to billions, deployed as a single instrument of will. The final level is not a fund. It is a position. It is the decision that markets, rounds, and the orderly progression of stages are too slow and too public a mechanism for the outcome you intend to produce. The sovereign wealth vehicles, the crossover funds, the single individuals who can write a check the size of an entire venture fund. They do not participate in the hierarchy. They bend it. They can fund a company past the need for any further round. They can keep it private indefinitely, starving the public markets of access. They can make a startup's success or failure a function of a single relationship rather than 1,000 customers. The logic at level 7 is not greed. It is gravity. At sufficient scale, capital stops chasing opportunities and starts creating them. Here is the thing that connects 2 founders with a slide deck and no revenue to a sovereign fund writing $1 billion check. Both of them made the same bet, that the story of what is about to happen is worth more than the evidence of what already has. That is the nature of this hierarchy. It is not designed to fund good businesses. It is designed to identify, capitalize, and own the appearance of inevitability before the rest of the world agrees it was ever inevitable at all. Money was never the product. Access to the next round was. The entire hierarchy is a system for owning the future before it arrives.
If this was useful, subscribe. See you in the next one.